Welcome to the final lesson of personal finance, investing basics. Now that we have discussed budgeting, goals, and the time value of money, hopefully we have begun to solve the biggest reason people don't invest. So now we will address the second largest reason people don't invest, because they just don't know how. Today we will look at an overview of growing your money through investing. Don't get too excited, because my goal is not to show you how to invest, although we will do a little of this. Instead, my goal is to show you how much you don't know about investing. When people think of investing, they usually think of buying stock like Apple, Alphabet, or the next Facebook. Unfortunately, most of the time, this is speculation rather than investing. As we move through this lesson, it is important to remember that the purchase of any type of investment is a two-sided transaction. Both the buyer and the seller want to make money off the trade, but they have the exact opposite belief about the future of the stock. Generally, buyers believe the stock will go up, allowing them to buy low and sell high, while sellers believe the stock is no longer worth holding. Couple that with the fact that a huge majority of trades are made by institutional or professional investors, and it becomes even more critical that you understand your limitations as an investor and come to grips with the idea that you may not be better than the market. So let's get started. The ultimate goal of an investment is to generate returns. Returns are the scorecard of an investment, and they indicate the percent growth of the investment. There are two ways that return is earned: either through appreciation of the asset. This occurs when the value of an asset grows into the future to be worth more than it is now. This is called a capital gain, while if the stock loses its value, it is a capital loss. The second way to earn return is through investment income, or payouts from the investment in the form of dividends. The formula for rate of return is very similar to all our growth calculations. Ending value minus beginning value plus income return, all divided by the beginning value. In order to annualize the return or find the average return each year, you simply divide by the number of years it took to achieve the return. Let's try an example. If we bought a single Facebook stock when they first went public at $40, and then we held it for 2 years and it was worth $60, after receiving a total of $5 in dividends over the 2 years, what is our return? In order to calculate this, we would simply take 60, the current value, minus the purchase value, plus any dividends we were paid, and divide by the purchase value. This gives us a return of 62.5%. Not bad, but we do have to remember to annualize it. We can annualize the return by dividing 62.5 by 2 in order to find our annualized average return is 31.25%. Like we learned about in the lesson on taxes, they also have a large impact on your investment. Dividends are taxed at your current marginal tax bracket, while any capital gain is taxed at 15%. Fortunately, the capital gains on your investment are not taxed until the stock is sold. This is one good reason to hold stocks for the long term. This allows your investment to take the maximum advantage of compounding. Let's now calculate our after-tax return on Facebook if we decided not to sell the stock and our marginal tax bracket is 20%. We would simply take the current value of the stock minus the purchase price plus any dividends minus the marginal tax bracket times the dividends paid divided by the purchase price. This gives us a return of 60%. When we actually sell the stock, we say that we have realized the return. What would be our realized return after tax on the Facebook purchase? Simply 60, which is our current price, minus our purchase price, plus dividends paid, minus the taxes on dividends paid, minus our capital gains tax on our capital gain of $20 from 60 to 40, divided by our original purchase price. This gives us an after-tax realized return of 52.5%. At times, this return value can be deceiving. When calculating return, you should also factor in any fees that you paid either to an advisor or transaction fees in order to execute the two trades. Getting back to our Facebook example, imagine that the transaction costs are $5.50 a trade. Now, what is our return? Well, we have to calculate our return based on the fact that we lose $11 when we execute the trades. So our current price minus our purchase price plus the dividends minus the amount of transaction costs divided by our purchase price gives us a return, a pre-tax return of 35% or annualized pre-tax return of 17.5%. Still not too bad. Now that we understand the scorecard of investing, it would seem obvious that in order to build the best portfolio, we should simply go out and find all of the investments with the very highest return. Although this might sound like an attractive idea, this would ignore one of the fundamental truths of investing. This truth is that there is an implicit trade-off between risk and return. We will discuss a couple different types of asset classes shortly, and the higher the return of the asset class, the higher the risk of the asset class, as shown by this chart. In an efficient market, the reason that some investments have higher returns than others is because the market must compensate those people who bear the risk. Although they have the opportunity to make higher returns, they also face the harsh prospect of higher losses. In investing, when we discuss risk, we are examining the variance of return, or how much does the return swing away from the expected return over time. The book discusses many types of risks that can be associated with an investment, but in general, we can group these risks into two categories, systemic and non-systemic risk. Systemic risk is the market risk that is described in the chapter, while non-systemic risk is all the risk that is uniquely associated with the investment itself, be it liquidity, financial risk, or business risk. In this case, Blockbuster in specific and the video rental industry in general succumbed to business risk as they were supplanted by newer on-demand technology. Meanwhile, every investment is affected by recessions as severe as the Great Depression. I'm sure at some point you have all heard someone say that you should diversify your portfolio. A portfolio is the investment you currently hold, but what is diversification? Many people know that diversification helps to lower the risk of a portfolio, but unfortunately they also believe that diversification is simply holding a large number of stocks. This second statement is only partially true at best. The book discusses the idea of not putting all of your eggs in one basket, and this is exactly right. Let's look at a couple of real-world examples. Notice in the chart, it seems like the percentage price change of Apple, Google, and Facebook move very closely together, and hopefully none of you needed to pull your funds out at around 9:45 a.m. on August 24th. This downturn only lasted a short period, but what if it lasted a little longer? This might create discomfort to you as an investor. Let's look at another chart. This is essentially the oil industry over the last 5 years. On the chart, we have British Petroleum, or BP, Royal Dutch Shell, ExxonMobil, Chevron, and a French and Italian oil company. Once again, the stocks are clearly highly correlated, and they are all subject to industry risk. Using these examples, it is evident that you would not want to diversify simply by buying up a lot of different energy stocks. The purpose of diversification is to combine many uncorrelated and negatively correlated investments in order to remove all non-systemic risk from the portfolio. This way, if a single investment in the portfolio does poorly with large negative returns, these negative returns will be offset by other investments that move the opposite way. If successful, the portfolio will be left solely with systemic risk, which means the portfolio remains susceptible to an economy-wide downturn. If a portfolio is properly diversified, it will lay on the efficient frontier and defy the risk-reward trade-offs by offering similar returns as other investments with lower risk. The efficient frontier is outside of the purview of this course, but the basic tenet of diversification is important for you to understand. Let's now turn our attention to a few of the most common asset classes. After cash, we move to government bonds. These are the same government bonds that we discussed through the macro block with open market operations. Through the use of government bonds, the government finances its large debt, allowing it to deficit spend. The U.S. Treasury bill is a short-term bill issued by the federal government with a maturity of less than a year. It is currently viewed as the safest possible investment due to the faith investors around the world have in the U.S. government's ability to pay its debts. This rate is widely used by financial institutions as the risk-free rate. The current yield for a 3-month T-bill is 0.32%. The government also offers bonds of longer maturity, including a 20-year bond. Currently, the yield on a U.S. Treasury bond is 1.9% on 25 July 2016. Governments, down to the municipal level, issue bonds to fund their operations. Clearly, the less stable the government, the higher yield they will pay. Here is a 3-month bond for the village of Highland Falls. Corporations can also issue bonds in order to raise money for projects they might want to take on within their business. These projects include anything from buying new equipment to buying other businesses. Clearly, corporate bonds are riskier than federal government bonds, but the amount of risk is going to be heavily dependent on the specific company. Not all corporate bonds are alike, and rating agencies like Moody's or S&P will rate the risk levels of different corporate bonds. This rating is based on the riskiness of the business, the business's current balance sheet, the business's leadership, and anything else that would affect their ability to pay their debts. Due to the increase in risk, you can expect a higher return than government bonds. Corporate bonds are viewed as safer than stocks because of where they are repaid if the business must file for bankruptcy. If a business files for bankruptcy, the assets are used to pay off all of the bondholders first in a specific order of seniority before the stockholders can lay any claim to the remaining assets. As a novice investor, you will typically purchase bonds through a mutual fund or ETF. Finally, the last asset class we will discuss is the one you all care about, which is the stock asset class. It is important to understand that when you purchase a stock on the internet, you are purchasing a tiny sliver of ownership in the company. The percent of the company which you own entitles you to the same percentage of the company's future profits. The risk that you bear is that this company, and thus your sliver, will become less and less valuable as they succumb to the forces of creative destruction. Think once again to the Blockbuster example. If the company is no longer capable of producing profits, then the value of your sliver will decline. Because we believe in generally efficient markets, the price of a given stock at any given time should directly reflect the value of all future profits of that sliver of the firm, discounted back using the time value of money to the current period. Thousands of professionals are bringing information into this market at a rapid pace every day, and this knowledge of the masses ensures that a given stock should be pretty fairly priced most of the time. As discussed previously, stockholders are the very last group to lay claim to the assets of a corporation in bankruptcy. Although this creates a large amount of risk, they benefit because, unlike bondholders, stockholders get to participate in the growth of the business. Before I go on, let's do an example and clear up a large misconception. If I go online and purchase 100 shares of Netflix stock, the current price is $87.66. 100 shares would then be valued at $8,766. If we then take the number of shares outstanding, which happens to be 428.3 million, we find that I own 2.04 times 10 to the negative 5, or 0.002% of Netflix. The misconception that I want to clear up is that stock price has nothing to do with a firm's value. Let's compare Chipotle Mexican Grill to Netflix. A share of Netflix costs $87.66. And now if we go to Chipotle, we find that Chipotle is currently trading for $441.52. Does this mean that Chipotle is a more valuable company than Netflix? Of course not. If you compare the total value of the two companies, Chipotle is worth $12.89 billion, while Netflix is worth $37.54 billion. The difference is that Netflix has many more shares outstanding than Chipotle. Moving on. Because it would be expensive to diversify by purchasing many stocks in their entirety, two financial innovations have developed in order to make this much more achievable. Mutual funds and exchange-traded funds are funds where many investors get together and group their money to allow the fund to purchase a large variety of stocks. This will allow each member of the fund to own a large number of companies. Their percentage ownership of the fund will be reflected in the same percent ownership of the fund's holdings or net asset value. Now let's discuss mutual funds and electronically traded funds. Mutual funds and ETFs are generally the same, with the biggest difference between the two is the fact that you can buy and sell ETFs throughout the day, while mutual fund trades are only executed at the end of each trading day, when they calculate the value of all the fund's assets. Despite these similarities, most people generally associate ETFs with index funds and mutual funds with managed investing. The key here is that you decide what type of mutual fund or ETF is right for you. There are hundreds of ETFs and mutual funds out there, but one thing you should consider is whether or not the fund is active or passive. Active means there is a manager that is attempting to pick stocks in an effort to bring you higher returns, while passive means the fund follows an index to match whatever portion of the market they are interested in matching. You can find these funds for every asset class and a varying amount of risk. The big thing that you want to take into account are the fees the fund is charging you. If you remember from the time value of money lesson, small expenditures can really hamper your long-term growth. Let's look at an example. Here are two funds that offer the same exact return of 7% over a 20-year period. In the more expensive fund, you pay $54,000 in fees, while in the Vanguard fund, you will pay $7,000. Due to compounding interest, this results in a $96,000 difference between the two funds at the end of 20 years. Remember, small differences make a big difference. So now that we understand all of these different investment vehicles, where should you put your money? This is called asset allocation, and typically the answer to that is going to depend. First, you need to understand what your risk tolerance is. I highly recommend taking the risk tolerance quiz from Rutgers discussed in your book. After determining your risk, what do you notice about this chart? The more stocks you have in your asset allocation, the higher the average annual returns. Also, the best year return increases with the percentage of stocks at the same time. But so does the percentage lost in the worst year and the number of years with a loss. Your asset allocation is going to depend heavily on your investment horizon, or when you will actually need to pull the money out of the market and use it for something in your life. Since you are all very young, you can all accept a good amount of risk with your retirement savings because you have a long time until you get there, and you know that on average, your portfolio will continue to go up. The closer you get to the end of your time horizon, the more important it becomes to avoid the type of loss associated with the worst year in 100% stocks, or negative 43.1%. This asset allocation will play a huge role in determining your portfolio's success. Let's look at an example lifetime asset allocation. Notice as you get older, you want to slowly increase the percentage of bonds you own in your portfolio because you are much more reliant on your investments as you age, and you are less and less able to generate income from labor. The rest of the lesson might seem a bit disjointed, but we are attempting to cover the basics in one lesson, so there is less time for transitions. Bear with me. First, you will often hear people talk about bull and bear markets. If you're going to be an investor, you must speak the vernacular. A bull market means the prices are rising because there's a lot of demand. You can think that bulls charge forward like a bull market. Bear markets, on the other hand, mean that stock prices are falling and there are many sellers. Second, how should you invest? We generally recommend you follow a dollar cost averaging technique, which is very easy to implement with the advent of automatic payments. Because the market and the economy typically grow, the idea is that you will purchase more shares when the prices are low, and this will allow you to maintain a return, as opposed to my canned example here, where you start with a lump sum and the investment is worth the same at the end of the 8 months. The other option is to attempt to time the market. As you can see from this table, if you can perfectly time the market in order to switch in good years to the stock market and in bad years to T-bills, the potential gains dwarf holding the other two asset classes. Now the question becomes, can you do it? Well, you need to look for some sort of cue to tip you off first. How about this one? Notice, the Super Bowl is held in February. This strategy is almost perfect. When the NFC wins, the Dow Jones goes up, while it goes down when the AFC wins. This hypothesis only failed 3 times in the 30 years between 1967 and 1997. 1975, 1980, and 1990. Let's use this strategy in order to market time. In the words of the great Homer Simpson, dope! This strategy only worked 3 times from 1998 to 2008. On a side note, this relationship is most likely not causal. In order for market timing to be worth it, you must be right 7 out of 10 years. Otherwise, you may miss some terrific gains and hit some horrific losses. The bottom line is that you probably can't do it. And to illustrate, let's play a little game. This website provides us the chart of a real-life stock over a certain period of time and allows us to try and time the market. Let's see how I do. It looks like the stock has been going down for a while, so I'm going to start buying. Good decision on my part. Uh-oh. Alright, well, it's going to start going up, so I'm going to keep buying. Uh-oh. As you can see, the source of this chart is the Apollo Group from November 2001 to October 26, 2006. Over this period, by trying to guess and time the market, I lost 14% or $11,000. This is significant when you don't have $11,000. Finally, there are mechanisms that you can put into place to protect your investments. While most of you will simply purchase stocks through a market order, this means that you will pay the price set by the market in that instance. If you are a little more wary, you may place a limit order, which allows you to set the maximum value you are willing to pay. The trade will not be executed unless the price drops below your limit. Conversely, if you set a limit on a sale, it will not sell the stock until the price is above your limit. Finally, a stop loss order will allow you to set a point where if the price drops below your specified point, it will automatically be sold at the next market price. This is a good safety net, But one thing to remember is that setting the stop loss order too close to the current price is somewhat foolishly increasing your transaction costs, because stocks typically fluctuate a good deal and you would not want to sell unnecessarily. This concludes our brief introduction to investment basics. I hope you have enjoyed these 3 lessons in personal finance. Have a great night.